let's begin with a very simple question, all right? Now, these are already highlighted because I want to be time efficient. You've already done like, I don't know, like an hour or something like that with me, and you're probably already annoyed and you don't want to hear my voice. That's why I took the time to just highlight them already for you. And if you want to find these questions without the solutions, without the highlights, you can definitely find them in the description below or on my website. If you want different questions, you could go on my website again, and you'll be able to find more on that. So don't you worry, you're good, you're chilling. We got everything you need here. So if we read this question together, we got Dunder Mifflin, and Dunder Mifflin wants to invest in a new industrial printer that will require an initial investment of $250,000 today. We know that an initial investment is something that we want to highlight. If I were you, I guess, on an exam, is I would go ahead and pick up my blue highlighter, and you're going to highlight this in blue. Why do we highlight this in blue? It's because we know that this is the initial investment, and the initial investment is color-coded in blue. So we highlight that in blue. We know that that's a cash outflow. And I almost went on my screen to highlight it like this. I'm a fool. I'm gonna go highlight it on the computer like a normal person. That was hilarious. So we have this right here. I guess we'll put it in the same color so it's actually, you know, like actually shows like I'm being a little bit professional. So we have our first cash outflow. Now, sorry about that, because this happens today, that we're spending 250K, this is gonna be a negative value that we don't need to discount because we know this is occurring today. If we proceed throughout the question, Michael Scott expects the printer to save 100 grand in operating costs per year for the next 4 years. All right, so now some bells should be ringing. We know that we're gonna get 100K for operating costs per year for the next, essentially that you're able to save 100K. All right, so that's gonna be like your cash flow, your saving, your payment. That's what you're getting, okay? You're able to save that money. If you save money, that's more money in your pockets, that's some cash, all right? It's gonna be happening for 4 years. Then we also want you to understand is that this investment, which is what we're gonna highlight in yellow, all right, is gonna be fully depreciated over its life on a straight line basis. So if it's being depreciated over the life of the project, we know that we're going to be able to depreciate 250K over 4 years. So you're going to do 250K divided by 4. That's going to give you your depreciation expense for every single year. And once you have your depreciation expense for every single year, you're going to be able to multiply that by the corporate tax rate, which is 25%, in order to find what your tax shield will be. How much are you saving thanks to depreciation? How much are you gaining as a tax shield? And then you have a bunch of little jazz, blah, blah, blah. And they wanted to let you know as well that your cost of capital trends towards 10.5%. And within all of that information that was provided, we want you to determine whether Dunder Mifflin should implement or reject this project, okay? So a few things before we begin, all right? What I want you to be able to understand is that because we only color-coded 3 things that we saw previously, which is our initial investment, our operating cash flows, and our tax shield, well, we only need to solve for 3 different things. We don't need to solve, for example, for our net working capital recapture, because here that's not what we have. So already there, you have some clarity on what has to be done. So we're only going to have to solve for this, and this, and this. Okay. Now, of course, the present value of your initial cash outflow, the present value of your initial investment is going to be equal to itself. Money that you receive today, well, that's the present value, all right? So that's already a walk in the park. So we could go ahead and maybe put like a checkbox next to every single one of these. So this is light work. If we move on to the operating cash flows, well, the operating cash flows, well, we could kind of, once again, we understand that this is all, time value of money. We could try to put them into a framework. So we know that we're receiving 100 grand every single year for 4 years. So let's go ahead and go on the next page and let's try to visualize that. So as you can see here, we could go ahead and kind of visualize it on this Excel manner, or simply by just using a timeline like this. You have payments happening at every single year except year 0, and you know that they're equal to 100K, right? However, if I'm being However, these 100 grand, these individual payments of 100K, Well, they're going to be subject to taxes. Okay, so you need to essentially do minus 25K every single year. Now, what's awesome is that you could simply do sales minus cost times 1 minus the tax rate, and that's going to give you the same amount because you would have 100 grand times essentially 1 minus 0.25% or 0.25, sorry, and that would give you 0.75. That's going to give you 75K as your payment for year one. It's really as easy as that. So that would be the first step in defining your operating cash flows, right? And we understand that your operating cash flows, well, they're going to be constant every single year. They're going to be the same amount throughout, okay? Such that for you to find a present value, there's a few ways of going about this. You could either, as you can see here, so I'll highlight them in red. I'm sorry that I'm losing my voice a little bit. I'm actually really excited. So I'm maybe a little bit more calm along the way, but smiles. I'm excited for you. You're understanding things. There's 3 ways, I guess, that we could go about this, even maybe 4. The first way, the most, I guess, foolish way would be to do the simple discounting method, at which you would do payment 1 over 1 plus k to the power of 1, then payment 2 over 1 plus k to the power of 2, and then you would add them up together, right? That would be the first method of going about it. Not the best way. The second way of going about it that I could think of is using the normal annuity formula. The reason why we know we could use a normal annuity formula is because we're dealing with a defined timeline, right? 4 years, at which we know that these payments are happening at the end of the year. And then we know that these payments are constant, okay? So we're dealing with a normal annuity, such that we could use a normal annuity formula to solve, right? If we know that our K is 10%, if that's still correct, our K is 10.5%, so that's just me that didn't give the rounding thing, but we know that K is 10.5%. We know that our payment effectively, right, after tax cash flows is 75K. We know this is occurring for 4 years. So we could go ahead and plug this into our formula and solve for a normal annuity, for a normal annuity's present value. That's one way of going about it as well. Another way of going about it is by plugging this in within your calculator. Now there's 2 ways to plug this in within your calculator, all right? So I'll go at C. And the 2 ways of doing this is by either just simply plugging in your IY, right, as being equal to 10.5%, your N as being equal to 4, your payment as being 75,000, and essentially the future value is equal to 0, then you would compute for the present value, right? You would do that, compute for present value. Like if you were looking at a hypothec or a loan, right? Or you could use the CF function, in which you would have CO1 as being equal to 75K, and you would have FO1 as being equal to 4. And then, of course, CF0, by the way, in this case, we're going to set it to 0 because we just want to know the present value of this right here. But, you know, technically you could add the initial investment, but then you would just need to look at another part. It's all up to you. But with that, you would put your I as being equal to 10.5%, and then you would do compute NPV. That's one way of going about it as well. The idea is here is that all paths lead to Rome, and you could choose a method that works best for you. But it's really important to be able to understand, if we look back at our prompt, that they told you something that looked a little bit complicated at first. Michael Scott expects the printer to save 100 grand in operating costs per year for the next 4 years. Oh my God, what do we do? Don't worry about it. Use a timeline, visualize the cash flows. Okay, year 1, 100K, year 2, 100K, year 3, 100K, year 4, 100K. Amazing. We know that that's our payment. That's super cool. We understand that. Well, if we know that's our payment and we know N is 4, and we know our cost of capital, and we know there's no G, and we know that we're looking at time value of money, we could just plug that in within our formula. Or if that's too much for us, we could go ahead and just plug it in within our calculator. There's a bunch of different ways to solve for this in an actual like easy manner, okay? So that's how you get your value for your present value of operating cash flows to be essentially 235,189. It's really, really, really important to understand though that our operating cash flows formula, it's sales minus cost times 1 minus the tax rate. You need to get through that hurdle first. Once you have that, you're able to just identify payment 1 and then just run with it, or all your payments. Sorry about that. My voice is a little bit rocked, so I'm trying to, run with it with y'all. So now that we have that, okay, we're good. We can move on to the tax shield. So I'll go ahead and I'm gonna use my yellow here. So the tax shield. How do we go about the tax shield? Well, let's kind of read the question real quick once again. In this case, they're telling you, hey, friend, this entire asset, this entire project or printer, well, it's going to be fully depreciated over its life. And what does that mean for you? If something is being fully depreciated throughout its useful life, it means that the residual value is equal to 0, okay? And it means that every single year, you're going to lose a portion of 250 grand, right? Over 4 years. So to find your depreciation expense here, you do 250 divided by 4. And if I could do some quick math, I'm going to say that that's 62,500. That's going to be your depreciation expense every single year. All right, so let's go ahead and look at what I wrote as your basic solutions here. So yeah, you're going to have your depreciation expense, okay? And that's going to be 62.5K every single year. That's awesome stuff. But we understand that our tax shield is equal to that amount times the tax rate. And if our tax rate here is 25%, so this is no bueno, we know that 25% times 62,500, let's just make sure that's actually correct so I don't have to make an adjustment. We know that that's equal to 15.625K. So this will be our tax shield every single year. So technically you're saving in taxes $15,625 every single year. You can even build a timeline if you want to. It's really up to you. Like, that's totally fine. Right? And you have this as being 1, 2, 3, 4. You would have a tax shield of $15,625 every single year. But the thing is, those cash flows, they're not happening today. They're happening in the future. And because the tax shield is occurring in the future, you need to discount it all the way back to t equals 0. All right. Now, in order to do so, it's kind of like what we discussed in the previous section for the OCFs. You could use a bunch of methods, right? You could use the simple discounting formula, which would be the sum of these individual payments over 1 plus k to the power of I. You could do that, or you could use the formula for a normal annuity. It's really up to you. They're both fine. Or you could use your calculator. Now your calculator, within your calculator, I guess, you could use one of two methods. You could either use the PV method, or you could use the, I guess we'll call it the compute PV method. Or you could use the compute and PV method. So I guess we'll call it compute. We'll do CF plus compute and PV method. So realistically, there are 4 methods that you could go for. Okay, go with the one that works best for you. This is literally I really hope that this is clear. This is once again just a timeline. Okay, we're looking at chapter 5 if you're at JMSB. We're looking at time value of money if you're at any other school, at which we're building a timeline and then we're discounting the cash flows. I'm pretty sure I have a few videos on this, but I may even create some dedicated how to discount cash flows video, just such that it's very, 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 very clear, okay? So now you get your present value for your tax shield. Hooray, hurrah, we're so happy. So what's awesome here is that there's nothing else that you need to do, right? Because this question only has 3 categories. It talked about the initial investment, it talked about the operating cash flows, and it talked about the tax shield. Once you have these 3 values, it's a walk in the park. You're going to do A plus B plus C, and that's going to give you your NPV. In this case, your NPV is greater than your your value, right? If you add anyways, make it simple. Your NPV is bigger than 0. And because your NPV is bigger than 0, you get an accept decision. Michael Scott should accept this decision. And Pam and Jim are going to be extremely happy along with Dwight. So that's how you go about it. That's how you solve a very simple question. And it's just to give you some perspective on what are we doing? Why are we doing this? Okay. Now it's a walk in the park. I know that it's not complicated. It's just meant to give you an introduction to what cash flow estimation is all about. Now we're going to move on to an exam-like